All right, I think we should get started now. So here we are at 6 o'clock. I want to thank everybody for joining us today. My name is Jen Vale. I am an associate director with Civitas Strategies. I'm joined here tonight by two of my coworkers, Ashley and Vanessa. They're not going to say hello, but they're in the background there. So they're going to help us with everything running smoothly from start to finish. Tonight, what we'll do is we're going to take all of the questions initially in the chat. So what I'd like you to do is throughout the presentation, as something comes up and you have a question, please put the question in the chat. And at the end of the presentation, when we're done with all the slides, I'll start to read the questions in the chat. And if we have time and if the size of the group allows, we also can have some folks come off mute and ask some questions if they're a little more detailed than what you would like to put in the chat. You also have the opportunity to email me if you would prefer. My coworker Ashley is going to be putting all of the links that you're going to see, anything that I refer to this evening, that there would be a website or a link. Ashley's going to put the links in the chat, and she's also going to put my email address in the chat, which is jennifer@civstrat.com. So Ashley's going to be kind enough to put all of that information in the chat for us. So I do have some QR codes in the presentation, but if you're watching this on your phone or you don't have your phone out, we will put those links in the chat so that you can save them. So we'll go ahead and do that there. I also just like to let everybody know that the topic of taxes, it's a serious one, right? And sometimes things come up that perhaps I, as the presenter, don't have an answer to. So we never guess. I'll never take a guess at it. What will happen is if I do not know the answer, I'll ask you to please put the question in the chat or email me. If you put it in the chat, please give me an email address that I can answer you at. I will get the answer and we will get back to you, because taxes are too serious of a topic to guess on. We don't do that. But tonight we're going to talk about getting ready for tax time. Before we start, just going to do a little disclaimer here. Just keep in mind that this is for educational purposes, not for legal or tax advice. So just giving everybody a chance to take a look at that for our disclaimer. Fantastic. All right, so first, just a little bit of information about who we are. So for 14 years, Civitas Strategies has worked with within the early child care sector. We work also with mission-driven organizations. Since the pandemic, a large concentration of our work has been centered around helping child care businesses grow and thrive. We work with the owners of businesses, and we also work with the organizations that support them. And we do this through coaching, training, webinars, and educational information that we provide. So as the need for support in the childcare community has grown, so has our team. So right now, our team consists of 19 individuals. We have a variety of different backgrounds, and we currently work with childcare providers and small businesses nationwide in 12 states. Now, we've had an intense focus recently on supporting childcare providers with tax education, right? Because the goal being is let's help maximize your tax strategies. Let's help you avoid risk. So we do spend a lot of time working with childcare providers on taxes. All right. So our goals tonight, we're going to cover a few very important topics. This will help you run your childcare businesses smoothly year-round, not just during tax season. So a lot of what you will learn, you'll be able to apply throughout the year. So first, we're going to talk about why you should care about your taxes throughout the year, not just on April 15th, right? So caring about your taxes, there are a lot of great reasons for that. For our home-based childcare providers, we're going to talk about what the Schedule C is, how you use it to report your childcare business's income and expenses. We're going to go over some steps that you'll take to get organized and to prepare your tax filings for next year, meaning, well, actually 2023 for this year, for 2024. And it's not going to be shown on the slide, but we will also have a little information. We're going to discuss depreciation just a little bit. It's a topic that's often misunderstood. So we have some easy tips to help understand depreciation. And we will share some tips to proactively mitigate your tax burden through deductions, contributions, retirement plans, and more. So the goal today is to provide you with tax knowledge to optimize your filing and minimize the issues that you will have during tax season. All right, so child care business taxes. So we've done some research, we've had some studies, and it illuminated several findings in one of the studies that we did. And we worked with child care providers, and we found out a few things that were really very concerning to us. We actually found out that 83% of the child care providers that we worked with did not claim the business use of their home at all, which sounds absolutely shocking. The IRS, we know, allows for those deductions on Schedule C, line 30, business use of home. There's a whole section for it. You can take any of the deductions that are associated with the costs that are shown as allowable expenses on the Schedule C. But we found that 83% of child care providers did not claim those expenses. So that was really concerning. The other thing that really was shocking for us is that in some cases, we found out that child care providers did not claim any expenses on their taxes at all. So it should never happen, right? Every dollar is important to reinvest into your child care program. Undoubtedly, child care providers are going to have deductible expenses to operate their business. You have expenses that are required to operate your business. So there should never be an instance where a provider is unable to find or claim expenses that are associated with their child care operation. You'll see that the Schedule C, the IRS Schedule C, does have many different expense categories under which the deductions fall. And we do encourage you to review each category line by line to identify what expenses qualify so that you can lower your tax liability. We did also find, concerningly, that many providers were claiming invalid business expenses, right? So that could drastically increase their chance of an audit, which can be time-consuming, expensive, and very, very stressful. While we advocate claiming all valid expenses, the keyword is valid, right? So not all expenses may be valid for your child care business. Some expenses actually will automatically trigger flags with the IRS. As a rule of thumb, the IRS considers a valid deduction to be ordinary and necessary, meaning that it's required for operating your business. So just keep that definition in mind. So the IRS does evaluate if expenses are appropriate based on your business type by reviewing your tax return. So different types of businesses, right, have different types of allowable expenses. And then another key finding was that there were several common deductions that were either miscategorized or improperly calculated. And when this happens, we can also raise an automatic audit alert. So basically an example is that a deduction for children's meals, let's say, for instance, many child care providers actually put children's meals on the line of Schedule C that says deductible business meals. But the IRS intends that line to be used when traveling, right? Traveling on a business trip, traveling to a seminar, not for children's meals. So just keep in mind, expenses in the wrong categories can prompt an audit, even if it's unintentional, right? So all the best intentions, something accidentally gets put somewhere in the wrong place, and this could cause a problem. So, all right. Now we're going to take a look into why you should care about your taxes. All right, so a lot of areas that caring about your taxes can address. So knowing how to effectively address your taxes can help you with, first, profit retention. So it's the responsibility of every business to pay their fair share of taxes, right? But proper tax preparation can be a vehicle for capturing your hard-earned profit. Keeping more money in your pocket. So you have to think about taxes in that light, that they will help you retain your profit. So if you understand allowable expenses, those legitimately result in paying less taxes and retaining profit. So we want to think about that. The second is risk mitigation. So education is key when it comes to understanding allowable expenses and properly preparing your taxes. So the more that you are aware of tax rules as they apply to childcare businesses, because there are some specific rules that just apply to childcare businesses, the less likely you are to trigger an audit. So audits are time consuming, right? We said they can cause distress at the end of the process. They can be very, very costly. So basically what often happens is an audit results in you owing money that you may not be prepared to pay, right? So we care about our taxes because we want to mitigate that risk, right? We want to make sure that we are avoiding that. Another great part of it is understanding your business health. So reviewing your taxes, fantastic way to review the health of your business. When you have an accurate account of profit, it really allows you to understand the financial position your business is in, and it can help you plan for changes going into the future. And fourth, build business confidence, Knowledge is key, right? So having confidence in knowing that you've properly claimed deductions and that you've met your tax obligation, it removes the factor of the unknown. Understanding taxes gives you the ability to continue to operate with the mindset that you are following the rules set by the IRS and you are unlikely to have any unforeseen debt or potential future problems. So let's just look at each of those areas a little deeper, should we there? All right, so we know when it comes to taxes, as we discussed, you have an excellent opportunity to retain profit. How do you do it, right? How you do it is you maximize the amount of allowable expenses you can take on your taxes. So having a very good understanding of what they are, what you're allowed, what you're not allowed, it does help you to make smart business decisions and minimize your liability throughout the year. So when we think about expenses, right, you do need to understand that when we think about expenses and retaining profit, I should say, you do have to accept that some of your expenses are what are known as sunk costs, meaning they've already occurred, they cannot be recovered, right? So some costs are things like rent and utilities. They're future costs that cannot be avoided, right? We know we're going to have rent, we know we're going to have utilities, but they are legitimate business expenses, right? So we know that even though we can't avoid those expenses, we are going to be able to take, if we are a center, we're going to be able to take those as a full deduction. If we are a home-based child care provider, we would be utilizing the time-space calculation to take rent and utilities and things of that nature there. So if it's a legitimate expense, you're going to deduct it on your taxes. Now, if you file your taxes, as we mentioned about home providers, if you file as a sole proprietor or a single member LLC, you file on your 1040 tax form, right? Your personal tax form. And when it comes to the amount of profit that you reflect on your taxes, you're most likely thinking about those self-employment taxes that you have to pay, right? And self-employment taxes, 15.3%. And you take those taxes off of the profit and that's taxable income, right? That's on your tax return filing. A lot of people think that this is a great incentive to reflect as low of a number as possible for profit, right? We want to limit our tax liability. Now we want to take every legitimate expense. We're entitled to every legitimate expense. However, if we are playing a game of lowering, hopefully we're never doing this outside of the IRS rules, but I do want you to keep in mind that if you are a home provider and you are applying for a mortgage or any other kind of loan, a lender can look at the amount on line 31 of your Schedule C. So what is that? That's the bottom line profit that you're going to be paying. Usually you'll be paying your self-employment taxes on, and you try to get that number low. But if you're going to be looking into getting any type of loan, they do look at that number. So we kind of have a little bit of a situation here where if we are applying for a loan, there's a chance that if we have that number so low that perhaps we won't qualify for a loan. So it needs to be realistic. Again, you're going to take all of the expenses that you're allowed. We're not saying don't take allowable expenses, but if you have a tendency to try to get that number really, really low, just keep in mind that you could, having a very low amount on line 31 of your Schedule C, it can be seen by lenders as not having a profitable business. So we just want to keep that in mind. All right, so how are we going to reduce our risk of an audit? Well, best way is to keep in mind some common red flags. So there are issues that often lead to an audit. We'll see the same issues over and over and over again. So if we were talking about home-based childcare providers, some of the most common red flags are not including all of your income on your taxes, okay? And that means that you have to report every 1099 that you received. Anything right from the child care resource and referral agency, anything that you receive from food programs, anything that you receive from parents, obviously all cash transactions. We need to make sure that we are claiming every bit of revenue, especially if they're 1099s. The IRS obviously knows that you've received that money. So you need to have really great processes in place throughout the year when you are keeping all of your receipts together so that you can basically balance those with the 1099 that you receive at the end of, in the beginning of the tax season, so to speak. Another thing that can trigger an audit, you have to be very, very careful, are taking off, like I said, a lot of expenses that perhaps usually aren't taken by childcare businesses, or something that's really, really high. And this is not an exaggeration, but someone in our company was working with a childcare provider, and they claimed $40,000 in cell phone expenses for themselves each year. Eventually, did they get caught? Yeah, they got away with it for longer than you would have expected, but that's pretty unreasonable there. Keep in mind now, if you take a large loss on your business, if you have losses year after year after year, we know that businesses will take losses from time to time. Okay, but that does happen. But what you want to do is avoid having losses that are in excess, far excess of what you've earned. If your business regularly loses money, the IRS is curious about why you continue to operate it. Sometimes they start to consider it a hobby. There can be a lot of questions raised. So you just have to watch out when you're claiming, if you are claiming losses, if they're year after year, the IRS is probably going to question that. And then the other is claiming 100% use of your vehicle. So you may have a car or a van that you use for transportation for your business, and that's allowed. But if you have a vehicle and you report that it's only used for work and it is used for personal reasons, that can draw attention. So we want to make sure that we're claiming, and we'll talk about how we can go about doing that a little later in the presentation. So as you can see, right, there are many red flags. So we want to make sure that we avoid those through proper preparation of our taxes. All right, now the business health, right? It's a great time. Tax time is a great time to evaluate the health of your business. For some business owners, it might be the only time that you take a hard look at what you're spending, what your overall business costs are. Obviously, I recommend that you don't wait until tax time to do this, but for some businesses, that's when it all comes to light. So taking that deep dive into your taxes means that you're taking an intense look at the results that your business is producing, right? So when you note profit, you are noting how much money you made. Are you as profitable as you thought you were going to be? If you're in no way surprised by your findings, chances are you've been studying your business health throughout the year. But if you find that you're either more or less profitable than you thought, this is the time to investigate why, right? Tax time is a great time to be able to do that. Was there revenue that you weren't properly tracking throughout the year, and then all of a sudden it comes to light there? Are there expenses that you forgot you had? At tax time, all of that comes to light. Another important aspect about taxes is that the results of your findings, right? How much revenue you took in, what amount of expenses you had, looking at that resulting picture of your profit, you can use that year after year to reflect trends, because you want to see how you're doing over time, right? Are you growing year over year? Did you have a few great years and then you had a decline in revenue? Or maybe you rebounded after a really difficult period, which is fantastic. But by analyzing the trends year over year for several years, you can look back on what has happened, what's different from year to year, and it helps you plan for the future. So you want to continue to take, obviously, actions that led to success, right? So if you look back in the past and you recall the actions that led to success that year, you're going to be able to use those basically use the actions that you took, repeat those actions, and adjust your course for greater profitability. So tax time offers all of that. Great time for business health, without a doubt. And then one of my favorites, right? You'll sleep better at night, building your business confidence. So having in-depth knowledge of the health of your business, it results in confidence, whether you are making the right business decisions. Now you have confidence, you can address any underlying issues. You don't have to fear the unknown. You are aware of where you stand, right? So I know exactly where I'm at. I don't have to worry about this. No unwelcome surprises, and you have a better understanding of the direction you want to take moving forward. So keep in mind, right? Peace of mind is priceless. So less stress, less worry. It means that you can concentrate on what's important, which of course is caring for the children, but also moving forward with a strong vision for the success of your business. All right, let's dive actually into taxes and take a look at common tax forms you're going to use. All right. So a little later in this presentation, we're going to talk about Homegrown's Tax Guide, which is the most comprehensive tax tool available for childcare providers today. That tax tool is really geared primarily towards sole providers and single member LLCs, but it does have information in there that centers can use as well. So we know that the Schedule C, what does it do? It helps us report our income, list our expenses, it determines our resulting profit, right? Basically, let's take a moment to look at each type of business structure so that we can have a good understanding there, right? So sole proprietorship, straightforward path for someone who is running their business alone. It simplifies tax reporting. You add your business income to your personal returns, makes it relatively easy. But there is some personal liability because you are the business and the business is you. There's no separation of your personal from your business. Sole proprietors report all their income and their expenses on the Schedule C. And as we mentioned, profit is then reflected on your personal 1040 as your income. So after paying the self-employment taxes and such. The next type of corporate structure is a limited liability company, which is an LLC, and they provide tax flexibility and they provide protection. They're a really versatile option for business owners, but you need to make sure that you are choosing the right tax classification. If you choose to, you can be an LLC and you can file as a single member LLC and still use a Schedule C and 1040. Or as an LLC, you can choose to file as a S Corp, or you could file for a C Corp, as a C Corp, excuse me. If you choose to do so, and I will say that S corporations are what are the most common in the childcare industry. If you do decide to file as an S Corp, LLC filing as an S Corp, you have to make a commitment for at least 5 years. So you can't say, this year I'm going to file as an S Corp, next year I'm going to file as a C Corp, then I'm going to go back to, you can't do that. You will cause some major tax red flags. You have to commit, you find a tax filing that works for you and you commit to filing that way for 5 years. We're looking for a 5-year picture. If you did decide, if you're an LLC and you decided to file as an S Corp, you then file on Form 1120S, and that form does not reflect any corporate tax. So keep that in mind as an S Corp, right? S Corps, they appeal to small businesses because they help you avoid double taxation on profits. But there's such a thing as pass-through taxation. You have to understand that. You have to understand shareholder responsibilities. S Corp, filing as an S Corp often is the most often used by childcare providers versus becoming an S corporation, because there are a lot of tax intricacies. The same thing goes for C Corps, right? Because it's a very uncommon choice for small businesses in general, home-based businesses especially, due to double taxation. So what does that mean? It means that profits are taxed at a corporate level before being taxed as personal income. So we really don't recommend that for home-based childcare providers, and I actually see it very rarely percenters. So just keeping that in mind there. And then another form of business structure are partnerships, right? So partnerships, it's very, you have to be very careful in that you have a clear agreement and an understanding of shared tax responsibilities. They're not just about splitting the profits, right? That's, excuse me, that's what everyone thinks about when they think about partnerships, but it's also about sharing the tax burden. So partnerships are legally binding agreements. Costs and profits are shared amongst partners. If you are filing a partnership, you actually use Form 1065 to file report earnings for partnerships. So Schedule C, right? So as a home-based childcare provider, maybe you've used tax preparers in the past, and you may be unaware that tax preparer filled out a Schedule C for you. Excuse me. Or you may be very, very aware. But if you've been having a tax preparer handle this for you, or you haven't taken a time to really look at your taxes, what does a Schedule C include? So let's take a look at that. All right. So income for a sole proprietor reported on the Schedule C. It becomes part of your 1040 form, your personal 1040 form. Now, if you have more than one business that aren't related, like let's say I have a craft business on Etsy and I drive for Uber and I do something else, I'm going to have separate Schedule Cs for each one of those little businesses that I'm running there. Now, when you are filling out your Schedule C, when it's being completed, the first thing that you do is you report all of the revenue, right? So all of the money that you receive from your business in every manner possible, every single cent that you've received, that gets reflected. Then you show all of the expenses, right? So the things that you paid for to keep the business running. And then you calculate the amount that remains. And if it's positive, you made a profit. And if it's negative, unfortunately, you took a loss. So, all right. So if we take a closer look at the Schedule C, there are different sections, right? And basically each section is for reporting a different set of data for your business. If you use a tax online, any type of tax software, basically the tax software asks questions, you answer those questions, and it would allot it to the proper place on a Schedule C. So answer questions, it knows where to put those. But I really do feel that even if you're using tax preparer software, it is helpful to know your way around the document. So part one is where all of your sales are located, as we said. You'll see that there's an area there that says cost of goods sold, okay? And we take all of the revenue and cost of goods sold, and that reflects our gross profit. Now, I will say one of the things that we do look for as a red flag is that childcare providers very rarely have a cost of goods sold. So you're not really selling physical goods for the most, we hope, for the most part, that you're taking an income based on tuition and assistance, subsidy and everything like that. But you may not have in your type of business, you may not have a cost of goods sold. So at times having something on that line for cost of goods sold can be a trigger with the IRS. So I just always say to everybody, hey, when you're looking at your Schedule C, make sure you have a legitimate argument for cost of goods sold. When we come over to part two, that's where all of the expenses are reported, right? Now, in the Schedule C, there are over a dozen categories that help you stay organized. There's advertising, car and truck expenses, legal and professional services, rent, travel, meal expenses. All of those are included on the Schedule C. And then that last section, as we said, right, that's where the net profit is calculated. So we take all of our revenue, take all of our expenses, subtract the expenses from the revenue, and what we see there is the net profit from your income as a sole proprietor, and that's on line 31 of your Schedule C. So, all right, we're going to switch gears a little bit because we're going to get to one of the very exciting tools, but in my opinion, the most exciting tool. We're going to talk about how you can proactively prepare for tax season, which helps you avoid the headaches down the road. Proper preparation is key to helping you tackle tax time like a pro. So as we go here's The critical tool. The critical tool is the Homegrown Preparing for Tax Season, a guide for home-based childcare providers. It has just been updated for 2023. The QR code that you see here is a link to the actual posting of the guide. My coworker Ashley is going to put anything that we refer to today that I either have a QR code or I refer to it as being available online. Ashley is going to be putting, if she hasn't already, put all of the links in the chat. So if you don't have your phone out and you can't use the QR code, by all means, go to the chat and look for those links. She'll have posted all of them there. So I have to say, I'm a little biased because we work with Homegrown on this as Civitas strategies, but this is one of the most important tools, right? Because it's the whole aim is to help home-based childcare providers optimize tax preparation. Um, the whole process to maximize deductions covers topics like record keeping best practices, which anybody can use, right? So I think I said in the very beginning, not just for home-based childcare providers. There's something in here that every business owner can use, but it has been created for the most part to address home-based childcare providers. But the record-keeping best practices that you can implement now, tracking income, expenses, mileage, business use of your home, track that all year round. Think about how easy next tax season is going to be. Also has a section about understanding the Schedule C. Again, capturing income, all the different types of business expenses. It explains how the business use of home works, right? Which is often a big question with home-based childcare providers there. It shows you how to calculate, how to document the time space calculation. Very, very important information there. There's a section that helps you maximize off write-offs with the eligible deductions for supplies, meals, utilities, repairs, insurance, all of those expenses there. There's a section that teaches you how to track and claim automobile mileage. For your business travel, of course. We're not talking about automobile mileage. We're not claiming personal use. Basically helps you depreciate, shows you how to depreciate assets over time, which is something that people often ask us about. Helps you take advantage of any type of pass-through deductions that may be available. Helps you choose the right business structure, right? LLC versus sole proprietorship. Proactive tax planning to help you with next year's tax return. It has checklists, it has guides, it has visual examples. They walk you through every step to support home-based childcare providers in preparing for tax season. There are actionable steps you can take, right? And action equals results, action equals success. Basically, it helps business owners, childcare business owners, make tax time easier, helps you save money. So we do work with Homegrown to update this resource annually, and I'm happy to say that the 2023 was just very recently published. So, all right, what does it come down to? Understanding your taxes, right? We need to find out what you made and what you spent. That's what taxes are all about. So, okay. First section of the taxes, as we said, all about revenue. How much money did I make? Getting this information is very easy if you have an accounting system. Okay, so if you happen to have an accounting system, you've been entering hopefully all of that revenue in your accounting system throughout the course of the year. But if not, you can use a worksheet. You can basically use a revenue worksheet to help you gather all of the information there. When you gather that information, right, you're going to have 1099 forms. We talked about that. They're an 1099 is an evidence that another business paid you for services, right? So home child care providers basically receive 1099 NECs for subsidy payments, participation in the Child and Adult Care Food Program for the CACFP. You receive 1099s in some instances if you have received a high amount of payments from apps like Venmo, PayPal, Square. The threshold did change in 2024 in 2023. Originally, you may have heard that in 2023, you were going to receive a 1099 for anything over $600 or higher that you received a 1099. You would receive a 1099 for any transactions, $600 or more in one of those cash apps, right, or Venmo or any of those. And that did change. Late in November, it was decided by the IRS that that $600 was not going to apply for this year. Okay, so things are different this year. They're going to be different in 2024, and they're going to change again in 2025. But no matter what amount, you have to report those payments. If you receive payments through any of those apps, you have to report that as income. You're also going to look at your bank records, right? What funds did you receive from other sources? And then you have all of your own documents, right? Which could be weekly receipts, year-end receipts, monthly receipts that showed what parents paid for care, anything like that. We're going to gather all of that together. All right. So basically, here's a revenue worksheet here. There's a link in the homegrown guide that takes you to a digital copy of that. So if you aren't using one of the one of your bookkeeping software systems, here you can go ahead and you just fill out a revenue worksheet. You include each 1099, you include revenue for every child that you care for. Keep in mind, it is important to also include money that you receive from grants. So if they're not on a 1099 for some reason, don't forget to include that as revenue. So part one is also, as we said, like the child and adult care food program. You report that there in part one, any 1099. But what's nice about the food program is that, yes, you report the income, but you also get to take the expense, the food expense. So there's basically, it weighs itself out. All right, we've collected all of our income. How much money did I spend? So now we need to collect the expenses, right? So what did you spend money on your business in 2023? We want to make sure that you have records of your costs, which are receipts that show payment for expenses, but you can use canceled checks, you can use invoices, credit card and bank statements, but every expense should show that you paid the expense, the amount that you paid, the date that you paid it, and a description of what you purchased or the service that you received. Okay, that is crucial should you ever be asked, if you would ever be audited, if you ever were asked the proof of an expense, what it was for. You paid the expense, the amount you paid, the date you paid it, and a description. All right. In the homegrown guide, there is also, I mentioned, a mileage log, so that can help you fill in your vehicle expense information. So that is a tool that's included in the guide there. All right, so now we've got all of our receipts. Month by month, we're going to go to the receipts. We're going to review our credit card bills. We're going to look and see, did we make any payments, right? So as we get payments in through Venmo, but did we make any payments through Venmo or PayPal or Square Cash or anything like that? Let's look at our bank statements and our checks. Once you get all of the expenses together, there's an expense worksheet in the guide that you are linked to a digital and the worksheet is also in the guide, but you can do something where you can actually input the information there. And basically, everything that's in that worksheet, if you look at the worksheet, are all of the allowable expenses on your Schedule C. It walks you through. It's a beautiful, beautiful tool to be able to show exactly, it shows you exactly what you're allowed to take off on your Schedule C. It's a great form of organization. So, but I can tell you that there's a lot of things here, as I mentioned, that could be used by any type of childcare business. So I don't want anyone who's participating tonight who's not a sole proprietor to think that there isn't something of value for them in the homegrown guide, because there definitely is. When you are doing these calculations, there is a whole section about the home expenses for home-based childcare providers. Keep in mind, right, when we're starting to think about our home expenses, you have to think about direct expenses as something that's incurred exclusively for a business and provides no personal benefit. So when you think about a home expense, that's the definition that I want you to keep in mind. So an example of a direct expense, if we had to think about direct expenses, an example is fixing a bathroom that's only used by children, getting a rug for a children's play area, playground equipment. So those are things that are exclusive to the business, right? There's no shared use, but shared use items could be things like your homeowner's insurance, your utility costs, right? That's going to be included on your Schedule C in the business use of home. You're going to use the time space calculation to think about that. When it comes to expenses, you want to basically hold on to all proof of payment throughout the tax season and for at least 4 years. All right. So don't get rid of those proof of payment, proof of your expenses there. If you have paper copies, fantastic, but you also want to have electronic ones or 2 paper copies of things there. Even if it's just snapping a picture with your phone, use your technology, right? Use the technology, make things a little easier for you. All right, now when it comes to taxes, there are a couple of tricky topics. We talked about really wanting to make sure that we don't have any red flags, that we're doing calculations properly, that we're putting things in the right place. Let's go over these topics that are considered to be tricky, right? So those are expenses for vehicles, business expenses when you run your child care business out of your home, how you calculate food expenses, and what tax circumstances you might run up against regarding stimulus funding, because we did still receive stimulus funding in 2023. So there are some tax considerations for that. All right, let's start with vehicles. That's a pretty common one. So basically with all, we just know in general, all deductions, there are very specific rules and guidelines that you want to follow. Vehicles, no exception to that there. So what you see here, these are all the elements that you need to make sure that your transportation is deductible. These basically, we have to address our transportation costs, have to address all 4 of these areas in order to be eligible for business, right? It has to be in the regular course of doing your business. It must relate directly to childcare, like picking up the children, or perhaps a business related not outing, but let's say if we're going to go to Costco to pick up supplies just for the childcare program. You're always going to have to separate your personal use of your vehicle and your business use of your vehicle. So just keep that in mind, because the record keeping, you often do have to show both. We'll talk about that. All right. So primary rule when it comes to transportation is if a trip can be used for both business and personal uses, but it's only deductible if the primary purpose of the trip was for business, right? So if I go to Costco, I've got a long list of supplies for my childcare business, but I pick up a jar of pickles for my family. My husband likes pickles. It's still deductible. That trip is still deductible because supplying my business was the main reason that we went to Costco. But if I'm going to the grocery store and I'm doing the grocery shopping for my family, and then I realize, oh, wait, I need a couple of items for the childcare business, that trip is not deductible, right? Because your personal errands were the primary driver for that. So you need to keep that in mind, right? We have to determine what was the purpose of the trip. So why was the trip necessary in the first place? If it was business, it can be a deductible trip, even if there were small personal items purchased along the way. But if the priority of the business of that trip was personal, and then you just had an incidental business expense, it doesn't qualify as a business expense. It's a personal cost. All right, now how do we deduct transportation costs? So there are 2 separate ways. So one is actual costs, using all of your actual costs, and the other is using a standard IRS per mileage rate. But let's take a look at the actual expenses first. So what does it do? It captures all actual costs associated with your vehicle. That does require extensive documentation, right? You have to keep every receipt. You have to log every mile. And when it comes to logging miles, you have to log the miles for business and for personal. So you basically, even if you're just taking a personal trip, if you're going to be using actual expenses, because you'd be looking at the overall mileage of your vehicle. This is for business, this is for personal. The pro of that type of method of the actual expense is that you may have a higher deduction, right? Especially if your vehicle's used extensively for work, you're going to most likely have a higher deduction than if you use the other method. But there's a significant amount of time taken to collect all those receipts, to collect those mileage logs, to get that all together. So keep that in mind. So actual expense amount can be a larger write-off, but it demands careful record keeping if you were ever to be audited. You have to track the business and the personal use, and you have to have a proof of payment for any vehicle cost. So that's if you're tracking actual expenses. Now, the alternative is if you track the IRS standard mileage, if you use the IRS standard mileage rate. It simplifies deduction tracking. Still means you have to have a log of the miles driven, but you basically are looking at your business miles driven. So the pros of the standard mileage is that there's an ease of calculation. It's very, very simple. There's fewer records to collect. You only track the business miles, not the personal. But the deduction, in terms of a con, the deduction is limited to that fixed rate that's set by the IRS. So that's basically it. That's the amount of the expense that you're going to take. Business miles multiplied by the rate per mile rate that's set by the IRS. Okay. It's interesting that records sometimes may get greater scrutiny. It's interesting, but as long as you have everything right, in the guide we talked about, there's mileage logs, there's teaches you ways to track your mileage, and there also are dozens and dozens of apps that can help you track business mileage. So this can be a very, very, very easy way to address your vehicle costs. But regardless whether you track the actual expenses or the standard mileage rate, you're going to need a log, right? You have to have the date, distance traveled, location, purpose for the trip, business versus personal if we're talking about the actual expenses. So you really are going to have to still carefully track mileage and the details of trips, and that's to justify the deduction. So look at each method and decide which one works best for your taxes. Think about the amount of time that you use your vehicle for business, and make that decision. Take a good look at it and see. Now, with home-based family care providers, let's swing over to the home expenses there. So you have a very unique set of circumstances if you're a home-based child care provider, because it is the only type of business in America that basically can have this concept of business use in a home, right? So basically, business use space in family child care is very, very unique as far as other businesses are concerned. So we're going to take a look. Let's look at how expenses work with home-based businesses. All right. Now, to figure out how much of your expenses are considered business expenses and what percentage of those expenses can be deducted on your federal income taxes, family child care providers will use the time-space calculation. So in time-space, what do? We look at our space and we classify it as either regular use or exclusive use. So let's think about those two and take some definitions into account. So regular use are all areas used during a day, play area, part of or all areas used during either all day or part of the day, but they also have other functions other than business, right? So we have areas in our house all day that I have the children in this room, we use the room. But when the children leave, we use it for personal use. That's considered to be what's called a regular use expense. Anything that applies to that, that's regular use of that space. Exclusive use of space means that it is an area that's used for child care program and nothing else. So there is no personal use whatsoever. So regular use, exclusive use. All right. And the IRS can actually come and check your home if they wanted to. So that's why we need to be very, very, very diligent in making sure that we make good decisions about what is regular space and what is exclusive space, or exclusive use, I should say. Regular use and exclusive use of space. So, all right, we've got a couple of examples here. So let's say we have a separate basement entrance and it's used only by the families of our child care business, right? There's no personal use whatsoever. Exclusive use space. If I have a storage room that's only for toys, exclusive use space. But on the other hand, if I have bedrooms for nap time, and I have the children using those, I have bedrooms that I have the children using for nap time, but they're the bedrooms for my family, regular use space. If I use my living room every so often for some type of activity, let's say STEM activities or such, that regular use space, right? It's used also by my family. So Keep in mind exclusive use space. Any cost associated with exclusive use space basically are deducted percentage of the home square foot, but the expense is 100% based on the square footage of the home. Regular use space is based also on not just the space, but the percentage of time that is used. So basically, let's take a look at that next. Let's look at costs that would be fully or partially deductible. How does that work? So let's take a look at that. All right. So costs for exclusive use areas, direct business costs likely are entirely deductible. Okay. So if we were replacing tile in a basement that's only used for childcare, or if we were installing a child-sized toilet, or liability insurance for a business, that's fully deductible. That's 100% allowable expense, right? That's exclusive use. But if I have an expense for regular use or common improvements, right, those are only partially deductible. It's based on the business use percentage, basically. So if I was replacing all the home windows, if I was repaving the driveway, those are basically, you must use the time space calculation to come up with that percentage of which you're going to be able to take from that expense, the amount you're going to be allowed to deduct. Basically, home insurance would be another one, right? Home insurance, I'm not going to be able to deduct 100% of my homeowner's insurance for my business because it's shared between my business and my home. So that would be something that is considered to be, an expense that we have to use the time space calculation for. Basically, we're going to talk more about the time space calculation in a minute, but what you need to do first is you need to look at an expense, look at a cost, and decide, does it directly support the business? Is there a benefit of shared space between home and family? Take a look there, and determine, is it fully partially, or is it a home improvement that has nothing to do with my business whatsoever? That's non-deductible. That's not something that I'm going to be able to deduct on my taxes. So, all right, time space calculation. I'm going to say broken down into 6 easy steps. Everybody's eyes glaze over. Nope, we can do this. We can walk through those, folks. All right, so remember, regular use, exclusive use. Okay. Time space. Now the time portion of time space weighs how much time regular areas, right, that are shared between personal and business use, and how much time those regular areas are used for business, right? So we want to figure out how much of that time do we use that for business. And exclusive use space is weighted 100%, right? Because there is no other use for that space. But regular use spaces, we have to think about the amount of time that they're used, that you use your home for business purposes as related to that expense. So what does the time space calculation look like? And you'll see we have a good example. We're going to break this down, make it very, very easy. All right, step number 1, I'm going to determine the square footage of my regular use space, right? So I'm going to measure all the square footage. I'm going to measure, the width and the length, and I'm going to come up with the square footage of every regular use area, right? The regular use space. I'm going to take that and I'm going to divide that number by my home's total square footage, right? So then I've worked on space, regular use space. Now I'm going to determine the amount of time my home is used for childcare. So what you do is you determine the amount of hours that you use your home for childcare, and you also can include the time before and the time after, the prep that you use and the cleanup time and things like that. You take all of that time and you divide that by 8,760. Those are the total amount of hours in a year. So now I've got a percentage there, and I have a percentage that I got from my space, right? When I took the square footage of my regular space and I divided it by the square footage of my home, came up with a percentage there. That's my space percentage. Now I've come up with my time percentage once I did the division of hours. Fantastic. I multiplied those two together. All right. The next thing that I want to do is I want to put that to the side for a second, and I want to think about exclusive space. I measure all of my exclusive space, And I also divide that by the square footage of my home. Okay, that gives me a percentage there. And what we're going to do is we're going to then add the exclusive use percentage, and we're going to add the regular use percentage that we came up with. And we're going to basically end up getting the result for time space calculation. So let's take a look at an example here. All right, so a provider has a home that is 1,500 square feet. 500 square feet of that are for exclusive use for childcare, exclusive use 500 feet. 700 square feet are for my shared use. I'm open 10 hours a day. I spend 1 hour before and 1 hour after for prep and cleanup, and I'm closed for 2 weeks vacation during the year. What does that look like? All right, let's walk by it step by step. So we know the home is 1,500 square feet, right? We start with regular use space. Okay, we said regular use space, 700 square feet. The length times the width of a room equals the square footage. If you have an oddly shaped space, let's say we have something weird, little nooks and crannies and things like that, just kind of like measure it in blocks. Just start thinking about breaking it up in blocks and adding those blocks together. All right, so I now know the amount of square footage for my regular space. I take that number and I divide it by all of the amount of the total square footage of my home, right? In our situation here, 700 square feet of regular use divided by 1,500 square feet for the total use of home is 46.7%. You can round up there. You cannot include outdoor areas. All right. Now, if you have an external space that's attached to the home that's regularly used, let's say like a deck or, it has to be attached to the home. So it can't be like a cement patio set off from the house. But if I have a deck, I can include that. Any expenses having to do with that, I can use my time space calculation for that. So, okay, now that I've done that division, I've got a percentage. I know what's going on in terms of space for my regular use. Now let's look at my time for my regular use, right? So how many hours a week is the business open, including the time spent preparing and cleaning up. And then I'm going to multiply that by the number of weeks that I'm open. And that's going to give me the total number of hours that are devoted to my business, right? So in this particular instance, open 10 hours a day, an hour of prep, an hour of cleanup, 12 hours a day. All right. I'm open 5 days a week. 5 times 12, I'm open 50 weeks a year. Fantastic. I'm open 3,000 hours. I take that 3,000 hours and I divide it by the number of hours in a year, which is 8,760, right? So I take that 3,000, I divide it by that. Now I'm at 34.2%. I'm going to multiply the two percentages that I came up with, right? The time percentage and the space percentage. We're going to go ahead and we're going to multiply those. So I had 46.7% and 34.2%. I multiply them together. I round up, that gave me 16%. Now let's go to the exclusive use, exclusive space, right? We said that was 500 square feet. What do I do again? 500 square feet divided by the total number of square footage in my home. That happens to work out to a percentage of 33%. Well, I take 33% exclusive use, I add to it 16% regular use, 49.3% of shared expenses can be used on my taxes. All right, so that means that my allowable home deduction for my expenses for my taxes is 49.3%. Not right. I mean, when you break it down by those 6 steps, it really isn't that difficult. If you've had the same percentage for time space on your taxes year after year after year, do yourself a favor. Unless you remember how you came up with that, if a tax professional came up with it for you without seeing your home, take some time, measure things out, do some calculations, see, is that a legitimate percentage? And perhaps you've been underestimating the percentage of your time space calculation, and that means you've been underestimating, underreporting the amount of your expenses. You could have been taking more expenses. So time space. All right, food. Another tricky topic, right? So it's a huge expense for childcare providers, probably the second largest expense that you'll have. So let's look at two different methods, all right? Just keep in mind, right? So the basics for food and meals are that food is fully deductible with two exceptions, okay? Now, if a child is in your care, fully deductible. And there are different ways you can report costs, and we're going to talk about that. But for staff, if you have staff, you can only deduct 50% of their meal cost. And if you're caring for your own children within the program at the same time, you cannot deduct the cost of their food. So now that we know what we can expense, how are we going to do it? So let's look at which method. We've got two different methods. All right, there's only two ways that the IRS allows you to deduct the cost of food. All right, now a family or a child care provider can use what's called the actual expense method, but only family child care providers can use the standard rate. So we'll take a look at that. We're going to start with actual expenses. All right, so you can deduct 100% of the actual cost of food consumed by your daycare, only 50% consumed by your employees. If you have, just so you know, as a little side, if you happen to have a party or something like that, you could actually expense 100% of that for your employees if you had a pizza party or something along those lines. But what happens with actual expense is that you keep track of every single food expense that you have. That means you're tracking every single cost, very, very accurate, and includes all of your cost. If you're doing the actual expense method, boy, there's a lot of scrutiny that can happen. You've got a big recording burden, and you need to make sure that you're completely buttoned up with those costs, that you're keeping all those receipts, that everything is itemized, that you're right on top of that, because the IRS may look at actual expenses, which is all that centers can do, may take a look at that closer than with family providers who can use the standard rate. So that is what the actual expense method is, right? It includes all of the costs, but boy, we've got to keep track of everything. So there's a burden to be had there. Now, standard rate, family child care providers only, it's easier to keep track of. It definitely is, right? So you still have to have a system, okay? And the reason you have to have a system is because you need to keep track of the types of meals, how many. It's easier for record keeping. You can deduct non-reimbursed meals and snacks. So if you have anything that isn't included in the standard rate, you can still deduct those as actual costs. The con is when we come to the idea of the basically documentation, you have to keep track of the name of each individual child, the dates and hours in attendance, the number and types of meals served, but you usually through your attendance records, you have the attendance already. And then it's just keeping track of how many meals and what types of meals were they. So the CACFP has reimbursement rates, and those are what are used by child care providers to simplify this calculation, regardless of whether or not you participate in the food program. So you use that standard rate. It's based on tier 1 under the CACFP. Basically, you are allowed to use the standard rate you can use for 1 breakfast, a lunch, a dinner, and 3 snacks, which is different actually than the reimbursement rate that you receive from the CACFP itself, which is usually only 2 meals and a snack or 2 snacks and a meal. So if you go to the CACFP reimbursement page on the USDA.gov website, you will see, you get to see those tiers and such. But definitely, because you're keeping enrollment records anyway, using the standard rate can be an easier way to go. All right, stimulus funding, another tricky topic. So let's take a look at how that affects your taxes, because a lot of you had the stabilization grants and other funding last year, right? You had it the year before as well, and that comes in, all of this comes into play. So let's take a look. So with stimulus money, right, you have to report that money as revenue. You have to, but you are allowed to then also deduct any expenses, any allowable expenses that you spent that money on, right? So think about it. I've got to claim it as revenue, but I'm going to be able to take the expenses off. Okay, that's great. But what comes into play is the timing. What happened when? So let's take a look at it. We have three different scenarios. Let's look at them. Okay, this one, very, very straightforward. All right. I received $10,000 in stabilization grant. Fantastic. The year that I received the money, I also spent it. So I had $10,000 in allowable expenses on my taxes. I received $10,000. I have $10,000 in allowable expenses. What does that mean? I have no tax liability, right? So yes, I had to record the $10,000 as income, but I also took $10,000 worth of expenses in the same year. That's key for that particular situation. All right, scenario number two. So let's say I got that same $10,000, but my revenue was 10,000. I took in 10,000, but for that year, I only claimed $5,000 in expenses. What does that mean? I'm going to be taxed on that remaining $5,000, right? So I have an outstanding $5,000 of revenue that was not covered by offset expenses. So we want to kind of keep that type of scenario in mind. If the amount of stabilization funds or any grant funds that we receive are higher than the amount of expenses we took that same year, you are going to have some additional tax liability. Now, this one is something that you want to pay specific attention to because with our stabilization funds, there were many instances when we were able to use to claim expenses towards stabilization funds that went back into the past. All right. So in this example, let's say in 2023, I received $10,000 in revenue. Well, I legitimately used it, but I claimed it on the expenses that I spent in 2022 that I took off of my 2022 taxes because under the stabilization grant, I was allowed to go back. So in 2022, I had all of these expenses. I took them off of they were all legitimate expenses for spending all of my funding. Great, I had those. Now, what am I going to do about it? Well, now I've got $10,000 the following year, and I've got nothing to offset it. That's just the reality of it. I'm going to be taxed on the full $10,000 because I don't have any expenses to count against that, right? To balance that out, to lower. So in this instance, my taxable income would be $10,000. So keep that in mind. When did you incur the expense? When did you get the money? And plan accordingly. All right, now how can you mitigate taxes, right? So what does that mean? How can we lower our tax obligation? Well, and how am I doing on time here? Yep, okay. So how can I mitigate? How can I lower my tax bill? There's something, even though the 2023 tax year has closed, there's something very interesting that you can do. All right, so everybody's thinking, I've already had every expense that I could possibly take in 2023. I did everything. 2023 is over. There's not a single action I can take in 2024 to lower my tax liability. And that's not the truth, because there is one other way that you actually can do this. All right. And we're going to look at an example of this, but this is something that I consider to be really exciting, a great opportunity. You can contribute to a retirement plan, and you can do that up until April 15th. And that comes off of your last year's revenue, which means it lowers your taxes for 2023. What does it do? It lets you put money into savings for your future that you now lowered your tax liability, and you can do that still for 2023 up until April 15th of 2024. So you could go tomorrow and you could open a retirement account and basically lower your tax liability, take the money that you had from last year. Now you're putting it into the future for you, your employees, whichever type of program that you set up. All right, just keep that in mind. I'm making an investment towards my future, and I was able to lower my tax liability. How fantastic is that? And it's the only, and I can do it from last year. I can lower it's the only thing I can lower my 2023 taxes on. How fantastic is that? So I really like it. It's something that you really can think about now over the next month and a half, right? Could you make a contribution to a retirement plan and lower your tax liability for 2023. You have to do it by April 15th, so you're going to want to get a move on it very, very fast because there is paperwork and things to be done. We'll talk through what type of retirement plan may be right for you. So just let's take a look here. First, I just want to look at, this is an example. So if I had $10,000 in taxable income, so last year, $10,000 in taxable income, I was going to have to pay taxes on all $10,000 worth. All right. But I decided to go back and make a retirement contribution of $2,500. So I had $10,000 that I was going to be taxed on, but now I can take $2,500, put it into a retirement plan. Now I've got savings for the future. I have a retirement account. And if we look at this example here, now I'm only going to be paying taxes on $7,500. I lowered my tax liability and I put money away for the future. You can do it for your employees. Let's look at a couple of different examples of what type of retirement plans you can use there. All right, so we'll think about what is right for you. The first thing is what's called a simple IRA. Very, very straightforward. You could save up to $15,500 from what you made in 2023. You choose the financial institution that offers a simple IRA. You fill out a form. Fantastic. It's a great way to start for beginners. What a great way to get a jump on retirement savings. It's, everybody says, oh, it's too late to reach. It's never too late to put aside tax deferred money if you're able to. So here we go. Let's do that. We've reduced our tax liability. And there's what's called a SEP ERA, SEP IRA. It's more generous. So you actually can put away up to 25% of your earnings, which is up to $61,000 for 2023. So if you have a large amount of taxable income, think about that you could reduce that by $61,000 by taking that $61,000 and investing it in a retirement plan. How fantastic is that? Well, you need to find a provider, an SEP provider. You set up an account, you make contributions directly from those earnings. If your business is more established and you want to save more money, that's a great way, an absolute great way to go. And then there's also the solo 401k that this applies as well. It's robust. It basically lets you put aside up to $22,500 plus 25% of your net earnings, maximum up to $66,000 a year. It's a little more complex there, but the higher contribution limits, right? You can contribute more. There's a lot of flexibility. There's some flexibility in it, in that you could, if you needed to borrow, you could, although you're paying yourself back and such. But 3 separate ways that you could take advantage of that. You could lower your tax liability from last year. A lot of people don't think about it. An investment into your future, lowering your tax liability from last year. Get off my high horse about that. Okay, now this is not something that we're doing right now, but we're in 2024. We can plan for 2024, right? Maximizing deductions. This isn't reducing 2023's tax burden, but now's the time to think about it. If I'm a home-based child provider, let's think about any deductions that I can take with shared use of home there. I've got to be really meticulous about my records. I have to make sure that I'm counting, I'm keeping every single receipt. I'm keeping track of every dollar that I've spent for these expenses. I have to stay organized. It has to be thorough. But you know what? Look through your records now. You're gathering all your records for your 2023 taxes. Start to think about what expenses you're going to have in 2024. Start to plan for those. Perhaps making really smart decisions, purchasing decisions, because you will be able to take those allowable expenses off of your taxes. So just keep in mind, and remember, with home-based providers, it's a large portion of your expenses are your shared expenses, business use of home. So just kind of you want to keep that in mind there. All right. Something that's really important is that you pay your taxes on time, all right? Because we're mitigating risk, right? We want to make sure that we're covering all of our bases here. Meeting the April 15th deadline, it's crucial in avoiding additional costs, because if you're late, there's monthly penalties, There's interest on unpaid taxes. They add up really, really fast. So basically, there are things that you can do to pay it back. You know, it's not the end of the world. You can have installment plans and things like that, but it's still costing you something. So really, if you stay on top of your tax payments, right? So if you're making, you're doing your estimated tax payments throughout the year, making sure that you're paying the right amount, installment amount for your estimated taxes, making, basically keeping on top of that, making sure that I'm paying my taxes by the 15th of April, just really making sure that I'm being careful about what possible interest and penalties I could be raising there. All right, what do we do next? What are the next steps? Well, when it comes to taxes, we can do two different things. We can get a paid preparer or we can self-prepare our taxes, and there's pros and cons to both. So with a paid preparer, right, you're going to look for somebody that's been recommended in your network. So because it is difficult sometimes to find tax preparers that are familiar with childcare businesses, especially home-based childcare businesses, it's really nice to be able to find a resource amongst your community and use somebody that's trustworthy, who understands how time-space calculation works, who understands the the business use of home, right? We want to be able to do that there. So if they've got that kind of experience, it's key, right? It really is key. So what's nice about it, I've got a guide along the way, right? So I've got somebody to help me. It can be expensive, but a pro is that they can offer me advice. So there's something nice about the having a paid preparer. Now, self-preparation is usually more cost-effective, right? It costs less to prepare my own taxes. It's very interesting in that, because if you're using online software, if you're doing your own taxes and not using an online software, this may not be the case, excuse me. But if you are using online software, basically the IRS tends to audit less frequently any type of tax return that's generated from a computer. So I apologize. When you're using those types of systems, right, and those types of tools, the IRS tends to audit those less frequently than if somebody actually prepared the taxes, whether it be themselves or a tax preparer. It's interesting there. They just find them to be more accurate and more beneficial for taxpayers. So it's usually less expensive. The calculations can be more accurate. Just keep in mind that if you need, a lot of times with that software, if you need guides, if you need additional guidance, it is extra. So just keep in mind, implement systems to track your income, record your expenses, make sure you have the right deductions to maximize your return, keeping on top of all that, regardless of which way you decide to go in terms of preparing your taxes, right? So we need to make sure that if we're using new resources or if we're using a paid preparer, we're still following the same steps to gather all of that information. All right, now, questions for a paid preparer. So if you're looking for a tax preparer for your childcare business, first thing, are they qualified? They have to have an IRS preparer tax identification number, which you'll see listed as a PTIN. They're required to register with the IRS. Ask for that number in advance. They should not be returned. They're not allowed to perform and prepare your tax return without one. All right. So you can use, there's an IRS directory. You can look up the PTIN number for the preparer you're considering using, making sure that they're qualified. Did they receive training? All right. So what type of credentials do they have? You can be an enrolled agent with the IRS, or they can be an enrolled agent with the IRS, which means they're licensed by the IRS, certified public accountants. There are attorneys that work as tax preparers. You may find tax preparers who participate in the annual filing season program. That's a way that teaches tax preparing. Bookkeepers, certified financial planners. If you go to the IRS directory, you can find a whole list of federal tax return preparers, so you can take a look there. As we mentioned before, right, next thing, have they worked with childcare businesses? Do they understand your needs, right? So experience counts, when you're talking about tax preparation services. So you want to know how long have they been in business, what kind of experience they have. Is that experience and that knowledge relevant to your circumstances, right? It's great if they're used to preparing taxes for a huge corporation, but if they're not familiar with family child care providers, what good is that to you there, right? Are they taking continuing education? Do they know all of the rules? Are they staying up to date on anything that could be changing, local, the state rules, in addition to the federal? Another key thing is, are they available after tax season for advice or changes? So we happen to be working on an expansion initiative in a state where anybody who wanted to apply for those funds and that within that state had to provide their tax returns. And we had a lot of people that couldn't provide their tax returns because they never got copies from their tax preparer. So you must make sure that you can get copies of your returns and that your tax preparer is available after tax season, right? So we want to get the copies, and are they available after tax season? You want to make sure that you get the hard copies, that you get back any copies of documents that you gave them. Basically, when you're using online tax programs, you can log in at any time, you can print out anything at any time. But when you're using a tax preparer, you don't have that same access, right? So you just want to make sure that you're getting a hard copy from a tax preparer, that you basically have received copies of any document that you gave them, and that keep track of those. You want to keep those tax returns in a safe place, perhaps paper, and scanning them to your computer, to a backup of the external drive or something of that nature there. And when you get back these papers from your tax preparer, make sure it's all the 1099s, all the receipts, proof of payments. You're going to hold on to all of that for at least 4 years. All right, so do that there. Now, if you are into self-preparing your taxes, if you want to start self-preparing your taxes, there are a couple of guides here. One is the TurboTax guide. So this is a link to the TurboTax self-employed online tax preparation guide for childcare businesses. Challenge you all to say that 5 times fast. So basically, if you go to a guide like this is a guide that's available. It helps walk you through the TurboTax process. Very, 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 very important. A lot of great information there. There's another link here that are all of the guides that help you understand stimulus funding, taxes, managing business finances, business operations. So those, we've got a tax guide, and then we have a link to many, many different guides that can help you with several areas of your business. All of this is free. It's easy to use. I'll leave the QR code up for a moment, but Ashley has also put these links in the chat. So I'll just give everybody, if you'd like, a chance to break out your phone or just go to the chat and you will find that there. All right. All right. Ooh, but wait, there's more, right? So what else do we have? Well, we've got another very valuable tool. So this is an app. It's called the Confidence and Quality Tax Rubric app. And it's developed based on actual family and child care center providers' tax returns. So we took actual tax returns and we used those to figure out and basically create this app. It's designed for sole proprietors and LLCs that are single member LLCs, I should say. If you report your taxes, your expenses, and your income on a Schedule C, this is of great help to you. Now, that's not to say that if you file as an S Corp, an S Corp partnership, any of those, that there are still things that you can benefit from on this app. It's free, it's easy to use. Test out the rubric, let it ask you the questions, see how it works. It is also available in Spanish. You'll see I have 2 links here, English and Spanish. Definitely, without a doubt. And again, these links will end up in our chat there. There's also a proactive tool that's basically called the Proactive Tax Planning Tool. I believe that Ashley has put that link in there. So Civitas really is involved as an organization in supporting childcare providers and their tax with their tax challenges and making sure that they're successful in all of your tax needs. So by all means, let's take a look there. And now this is somebody that you may be familiar with. So everybody knows Tom Copeland's Taking Care of Business blog, right? Well, we happen at Civitas, we happen to now be the stewards of the blog. So the blog has passed from Tom, who has retired. He's living a great retired life. That responsibility has basically passed over to Civitas Strategies. Still free, 1,500 articles, the amount of content. It's Tom's content, and we are adding new content on a regular, consistent basis. We answer emails, we answer calls. Here's the website. You know, if you've used Tom's blog in the past, there's no reason to not refer to it there. And we do really on a weekly basis answer emails. Maybe sometimes we gather them depending on how many questions we get. We gather them and we answer them in groups, but it's still something that we are actively working on. And then our YouTube channel, because what we do on our YouTube channel is we have over 600 videos. So videos that you can go and you can see about building a monthly budget, family handbooks, more tax tools, or the tax tools we talked about today. You'll see videos on those here. Planning for retirement. They're in English, they're in Spanish. We update them. We have Ask the Expert videos where the owner of our company comes up and, and has some great conversations. We add new content all the time. Here's the QR code. Please, by all means, come to our channel, our YouTube channel, and follow us there. So. All right, so now questions, folks. So let's see here. I'm going to go into the chat and see if I do have any questions. I know everyone, you were posting your registration numbers, right? Let me just kind of come in here. All right, I'm going to go right up to the top. So bear with me, and it is going to just take me a moment. I don't know if I have any coworkers on that could read me questions. Let's see. I do see that a lot of people have put their registry ID number in there, which is important, your name and your registry number there. Okay, oh, good. So Karen was with us. Thank you, Karen. I'm glad you'll be sharing that, the recording afterwards. We appreciate it there. All right, here's our friend Ashley has put some very nice links into the chat for us and has included my email, which is jennifer@civstrat.com. You're more than welcome to reach out to me. I see Grace, Karen had mentioned, yes, it is going to be recorded and shared. What is the registry number? I don't know if Karen can unmute and jump in and share with that. In terms of receiving the certificate at the end, Karen, if you want to either go into the chat or take yourself off of mute, please. Oh, good. Here we have Karen. Thank you. Recorded and it will be shared afterwards. Again, a question about the registry ID. So we have a couple of those. Can you share the link with people who could not attend? So obviously they're going to have the recording and you're going to be able to share that. So that's fantastic. Look, there we have Danielle has been kind enough to post the link for to create a registry ID. So if anybody wants to go take a look at the chat, Danielle was kind enough to place that there. Karen has a great reminder for us. This content is also going to be offered in Spanish a week from today, February 6th. So the same presentation, my amazing coworker Vanessa will be presenting. I'll kind of be hanging out with Vanessa in case there's any questions that come up that I can help with there. Is partnerships best? This is Cassie. Are partnerships best for married couples working together? Partnerships best. Here's a deal, Cassie. You and I are going to, we're going to have to meet again because it's an interesting question and it's not just a simple answer. So Cassie Stout, if you don't mind putting your email address in the chat with that question, are partnerships best for married couples working together? I'm going to go back to Gary Romano, who is the owner and CEO of Civitas. I'm going to put that question out there and let's find out what Gary has to have. And Karen, I will share that with Homegrown as well in case anybody else has the same question there. So let's see here. So still reported for 2023 tax year. This is from Rhonda. So even if we are not getting a 10, yes, so Rhonda, even if now that the rules have changed for the 1099s and you're not going to get a 1099 this year for $600 or more, you still have to report that as revenue. So even though you're not getting a 1099, any revenue that you take in through any of those apps, you must declare, even if you haven't received a 1099. Okay, so time space, yeah. So Robin Dean, did you say we could use a porch attached to the house? It has to be attached. I will tell you that wood structures are favored more than uh, than a patio. But if you have a porch, an overhang that is used in some way for your childcare business, you can use that in your time space. It has to be connected to the house. So it can't be a gazebo. It can't be anything that's set apart. But if it is attached to the house and is used within your childcare business, you could include that in your time space calculation. All right. I'm a licensed tax preparer. Okay, we have a Charday Neal has reached out. So Charday, Karen, I hope it's okay with homegrown, but Charday has been kind enough to give us some contact information that we could reach her at. I don't know, Karen, if you want to make note of that. We're going to collect this in the when we save the chat. But Charday, I'm glad to hear that you are a licensed family childcare provider and a licensed tax preparer. So that's fantastic there. All right. Oh, and there you go. So there's the PTIN has been requested. It looks like so we also have Carla Garrett from Child Tax LLC sharing her PTIN on there. Oh, I'm glad I have a nice comment here. Thank you, Jennifer. I'm glad that this was information was helpful for you. What state are the tax preparers in? Yes, please. Rhonda is asking. Charday and Carla, do you want to put in what states you are located in? There, I did not save my receipts. Do I have to claim expenses? Jacqueline, you have to claim every expense. All right, don't have to, excuse me. You don't have to claim every expense. You're going to want to claim every allowable expense. It is tough, hon, if you don't have your receipts because you would have no proof of which to show those expenses. So I do recommend that you dig through your records, find whatever documentable expenses you can. You're not required to take expenses. It's what lowers your tax liability. So in terms, do you have to claim expenses? No, you don't. Should you? Yes, you should to lower your tax liability, but you will want to have documentation. All right, so just that's for Jacqueline, just to keep that in mind there. All right, so Jacqueline, same Jacqueline? Yes, same Jacqueline. I only had children for 2 months. Do I claim my car payment and car insurance for the entirety of being open? Well, Jacqueline, it would all depend on how much of your car was used for business purposes, right? So if you had a legitimate licensed childcare business that you were filing business taxes and you had an allowable automobile expense during that time, that is something that you could use. However, you cannot claim you will not be claiming your car payment. You can claim expenses related to the repair of that automobile or the mileage that you occurred. You're not going to be claiming your car payment. So just keep that in mind. In terms of daycare insurance, any insurance that related entirely to your business would be 100% deductible. Your homeowner's insurance, you'd have to use your time space for. Okay, Shannon, so we are receiving a rehabilitation grant in Nebraska. A lot of providers have looked at replacing windows in their home. There's been talk amongst providers if we can use it as a time space and how much we can claim for this year on taxes. All right, so can areas of 100% daycare areas be claimed for 100%, or does time space apply? All right, so just keep in mind, if windows are used shared between your family and your childcare business, time space applies. If I had a room and I was only replacing the room that is only used for the care of children, and I was replacing those windows, that is basically exclusive use space. 100% of that expense would apply. But if I'm looking at the overall cost of replacing windows in my home that happen to include the rooms that children are cared for, perhaps shared with my family, we'll say, that's where time space would come into place there. If it's less than half the house's windows, doesn't make a difference. If it's less than half the house's windows, but some windows are used in an area, shared area for childcare. So let's say children are being cared for in the living room. There are living room windows. Only the living room windows were replaced. Those are you have to use your time space calculation because that is regular use space. It's shared space between your home and your business. But yes, it doesn't have to be every window in your house. What you have to determine is, are these windows that are shared between your home and your business, or are these windows that are only used by your business? So that's there. What liability protection does an LLC provide? So Kathy, probably more than what I can discuss in here. Basically, remember, when you're an LLC, you are no longer, you are no longer the business. So your personal assets are no longer, you're no longer liable for anything that could happen with your personal assets. Your business is still exposed. You still need liability insurance. Just because you're a limited liability company does not mean that you don't need liability insurance. So you would still need that, but your personal assets are protected. There are other things that are involved, but that's basically it. So when we're a sole proprietor and we're not an LLC, our business and our personal are all the same, and anything that happens to the business basically happens to the personal, but it's one unit, right? You're filing your taxes on your 1040. If you incorporate and become an LLC, those two pieces then become separate for liability purposes, right? So for the liability, so that basically, if something were to happen within your business, they would not be coming after your personal assets. So that's the breakdown there. Pamela looks like she's asking again about, not asking again, Pamela is asking about the registry number. Here we have a question: what is the email? I don't know if we're referring to my email. My email is Jennifer@civstrat, CIVSTRAT.com, but I'm not sure, Erica, what email you're referring to there. Karen, yep. Oh, so homegrown cannot offer CEUs, but if you would like an attendance certificate, you can request one. So Karen has made a very nice notation here that she'll share a form when she sends the recording, and therefore you can get an attendance certificate. So thank you, Karen. Do you help nonprofit issues with taxes? So, Doctor, just basically, we work with organizations within states on tax education. However, those organizations have engaged us to work directly with providers. Why don't you do me a favor, Doctor, and Dr. Almodovar, excuse me, Angela. If you don't mind, again, Jennifer@civstrat.com, can you do me a favor and shoot me an email and tell me what your concerns are? We usually only work with organizations that have engaged us in what's called tax education coaching, but by all, please reach out. Perhaps the owner of Civitas Strategies can be of some assistance there. Carla has put in her, so Carla Garrett of Child Tax LLC is in Michigan. All right. And Charday is listed, it looks like she's in Fresno, California, for anyone. Okay, I see, Doctor, that you messaged me directly. So please, by all means, just reach out via email. Okay, and you and I can have a discussion about that. Sorry, an expansion question on Windows from Shannon. Can it be claimed all in 1 year or depreciation? Okay, depreciation, right? So if it is a repair, it doesn't have to be depreciated. If it is a replacement, there is something called Section 179. And what I'm going to suggest, Shannon, is that you reach out to a tax preparer, tell them that you have this window expense, and Section 179 is going to be property. This is where you're going to want to involve a tax preparer, Shannon. But again, because I never guess, what I would like you to do is, this may not necessarily be bonus depreciation. It's not going to be bonus depreciation. It may be safe harbor. Could you do me a favor, Shannon, and just email me when you get the chance, Jennifer@civstrat.com, with this question so that I can bring it back to Gary and we can talk about depreciation on replacing windows, okay? Because it's not the same as purchasing an item, which is, you can use Section 179 depreciation. but there's also what's called bonus depreciation, but there's also safe harbor. Kind of curious, it would help me, Shannon, if in that email you tell me the cost of those windows, would be very helpful. So there we go. Oh, and thank you, Rhonda. So Rhonda's asked for the date and the link, and Karen has very kindly given us. How am I doing time? Oh my goodness, Karen, I apologize. I didn't realize how late we were running here. If you're an LLC, wouldn't your house be business and not personal? However, your expenses are not business. If you're running a home-based childcare provider and you are an LLC, you cannot be your personal assets cannot be sued. However, you still have to use business use of home on your taxes to your time space calculation to calculate any shared expenses, business at home. Being an LLC does not change the way that those expenses are taken care of. If you're an LLC filing as an S corporation, Kathy Baker, I would like you to email me, again, Jennifer@civstrat.com. Let me know those particular circumstances. I'd be curious to see what, I have a question for Gary about that. Okay, let's see here. I don't know, Karen, if you see this from Della Henderson, when we receive the certificate, can we use this time for the Workforce Pathway Grant? Not aware of what that is, Karen, so. Oh, great. Karen has shared the link for the homegrown, and I apologize if that wasn't shared earlier here. And Erica, so Erica, I'm going to have you send me an email just because of the amount of attendees in tonight. So Jennifer@civstrat.com. Please send me emails with your question. Let me know that you attended the homegrown webinar because we are doing other webinars this week. I have to apologize to everybody for running over. As you can see, I'm a chatty Kathy. But do we have anything else? Because I'm more than happy to hang on if anyone has anything else. Civitas is more than happy to help you. And anyone, even if you didn't put a question in the chat, if you have a question for me that didn't get brought up, again, please feel free to email me and I will confer with the owner of Civitas Strategies and get you the most accurate answers there. And I do see Karen has made a little note here for Della. So we have that there. What is my email? So my email is Jennifer, JENNIFER @civstrat. So that's short for Civitas Strategies. CIV as in Victor, STRAT.com. So Jennifer@civstrat.com. I sure can. I think they put it in the chat for me earlier. But we've got a lot of comments in the chat, right? So there we go. Oh, I saw. Up. So you know what's happened is that they have taken me out of this meeting. Hold on just a second here. Everyone in this meeting. There we go. Let's try that. I was accidentally sending it to a coworker. So Jennifer@civstrat.com. You should feel free to ask me any tax questions that came up in after tonight's presentation. Oh, thank you, Vanessa. Vanessa is our coworker who will be presenting next Tuesday. We will be presenting the Spanish presentation, and I will go ahead and join there. And again, anybody, please feel free to email me with any questions that you have. I think we're going to start to wrap things up, Karen. I apologize again for going over. I didn't mean to be disrespectful of anybody's time. We really wanted to get as many questions answered as we possibly could.